I welcome you to the conference call pertaining to the results for the quarter ended 30th June 2018. We have present here Mr. Sunil Duggal, CEO, Dabur India Limited, Mr. Mohit Malhotra, CEO, India Business, Mr. Lalit Malik, Chief Financial Officer, Mr. Ashok Jain, Vice President, Finance and Company Secretary, and Mr. Ankush Jain, Head Financial Planning and Analysis. We'll start with an overview of the company's performance by Mr. Duggal, followed by a Q&A session. I now hand over to Mr. Duggal. Thank you.
Thank you, Gagan. Good afternoon, good morning, ladies and gentlemen. Welcome to Dabur India Limited's conference call pertaining to results for the quarter ended 30th June 2018. On a comparable constant currency basis, consolidated revenues from operations grew at 19.6%. Domestic FMCG business witnessed like-to-like growth of 23.7%, driven by one of the highest ever volume growth of 21%. Consolidated operating profits increased by 25% in spite of high media spends, which grew by 46% on comparable basis. Consolidated operating margins expanded from 17.3% to 18.6%. If we exclude the GST impact, improvement in operating margins was around 80 basis points. Consolidated profit after tax reported growth of 24.6% for the quarter. Standalone India business reported growth of 24% on a like-to-like basis. Standalone operating profit grew by 35% in spite of media spends increasing by 48%. SG&A expenses reflected some savings on account of cost synergies. PAT reported growth of 35.9% in standalone in spite of the sharp increase in A&P expenditure. The revenue growth was broad-based with all verticals showing strong double-digit growths. Healthcare portfolio reported growth of 23%. Health supplements grew by 27.5%, led by strong double-digit growth in both Chyawanprash and honey. Market share in both categories reported an uptrend. Dabur Honey continues to ride on its strong brand equity and above-the-line spends, which are adding to the momentum of the brand. Digestives category recorded 21.6% growth on the back of good growth in Hajmola tablets. New variants, focus market inputs, and distribution expansion contributed to driving this growth. OTC and ethical grew by 16.9%. OTC products such as Honitus, Madhuvani, Lasdale, and Mahabringraj hair oil posted good growth backed by marketing initiatives and activations. The classical ethical portfolio grew by 23.4%, led by medico marketing initiatives and on-the-ground activation. HPC vertical posted growth of 19.7%, led by strong performance in hair care and skincare. Hair oils category registered growth of 18.8% on the back of strong growth of 45.3% in coconut oil category. Volume market share in hair oils moved up by 70 basis points vis-a-vis the same quarter last year. Shampoo category posted robust performance, growing by 30.3%. This is the third consecutive quarter where this brand has grown at 30% plus. Oral care category grew by 17.3% with growth of 16.8% in toothpastes. Red franchise continued to perform well, driven by increasing penetration, aggressive marketing, and visibility initiatives. Home care category grew by 17.4% this quarter due to strong performance of Odonil and Sanifresh. Skincare registered growth of 27.1%, driven by strong performance of the Gulabari portfolio and Fem bleaches. Oxylife, which is on a premium platform, posted strong double-digit growths. Facial kits and Fem hair removing cream also performed well. Foods business has made a strong comeback with growth of 26.1%, driven by good momentum in the beverages portfolio. Along with increased sales growth, profit margins in foods saw an improvement of 380 basis points on account of network optimization and lower input costs. Various strategies are being adopted to counter competition, including aggressive media spends, tactical consumer promotions, and sampling. We have also launched a new ethnic range of juices under the Real brand with 3 new variants. International business reported growth of 11.5% during the quarter, with constant currency growth being 10.5%. GCC market posted strong revival with 17% growth, led by Saudi Arabia, which grew by 54%. Egypt market continued to perform well with growth of 31% in constant currency. Turkey registered constant currency growth of 37%, although currency devaluation brought it down to around 11% in INR translated value. Namaste saw a turnaround with good improvement in profitability and double-digit growth in the sub-Saharan African region. The year has started well with some green shoots in demand, normal monsoons, and trade coming back to relative normalcy after the GST disruptions. We will continue to invest strongly in our brands, distribution and infrastructure to continue to grow ahead of the market and enhance shareholder value. With this, I now open the Q&A and invite your questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Sir, congrats on a very good set of numbers. My first question is, in beverages, NPD is around 3.8% of the revenue. In terms of the overall India business and in some of the categories where you want to call out, what is the similar NPD number?
The NPD, other than beverages, has been pretty muted in the last 1 year. We haven't done too much other than, Red and Red Gel and a couple of other initiatives. But the situation did not permit a whole lot of new product initiatives, which we will start doing now. So I think we have a strong pipeline of new products, which we will take to market in the quarters ahead, particularly in the second half of this year. So by the year end, you will see a considerable amount of acceleration in this pace of growth.
In the toothpaste, Red has done quite well in spite of toothpaste base being 10% growth. So if you could tell us, in terms of the Red Gel, are you able to get new customers? And in terms of the non-Red toothpaste portfolio, how has been the performance? What is the way forward? And in terms of the category, are you seeing lesser advertisement in general by the players in the toothpaste and more promotion? And if that is the case, what will be your strategy?
Well, to answer your first question, Red Gel is doing reasonably well. I think we need to accelerate the growth, and we have some initiatives in the pipeline to enable us to do that, including some formulation changes, etc. The other toothpaste has been a mixed bag. Miswak has done well, strong double-digit growth. Babool has not. Babool has actually declined marginally over the previous quarter, so over the base quarter. And that's because of the very high competitive intensity at the 10 rupee segment. So again, we have plans to resurrect Babool and relaunch it in a different kind of formulation, etc., in the next couple of quarters. So Babool, I think, will come back to normalcy, but with a lag of a quarter or two. Red continues to grow ahead of 30%, and that's amazing considering the high base. Miswak is a very steady performer. So the value-added segment of toothpaste is doing well. The discount segment is not. So overall, the blend is to our favor, but we need to do something about Babool to push the momentum forward.
And so in terms of the category advertisement and promotions, are you seeing a change in the mix in terms of the advertising?
Yeah, I think the new entrants into the herbal space are advertising very aggressively, particularly Colgate. So that's one dynamic which has changed. I don't think the overall intensity has increased, but there's a pronounced shift in advertising away from the traditional toothpaste towards herbal, particularly by the market leader. And this might continue. It's not very clear. But overall intensity, I think, is pretty normal. Am I right?
The trade spend in the category has actually enormously gone up, and the price decreases are happening across the category. If you look at the category growth also, the value growths are muted, but the volume growths are very high, almost double of the value growth. So therefore, the trade intensity and the competitive intensity at the trade level has gone up. And media, as we see going forward, I think media will also intensify by the competitors.
But above the I think reasonable, nothing extraordinary. Below the line in terms of particularly sharp reduction in prices by the new herbal entrants are really the standout feature of the last quarter or two. But I think we are still pretty happy about the performance of our value-added portfolio. Despite all these challenges, we have been able to hold our head without resorting to any great level of discounting.
So one follow-up here. Have you seen any impact from Ved Shakti and Ayush? And on the gel portfolio, you expect some impact in the coming quarters because of this?
Well, I think the Colgate offering, the cheaper one, perhaps is taking some share away from the discount players, but very marginal. And the other brand doesn't seem to be really very material at this point in time. But it's a very aggressive price strategy more than anything else, and which can be countered. But otherwise, I don't think the Red franchise has in any way been impacted. Perhaps to some extent, the Babool lack of performance in Babool is a consequence of this very aggressive discounting by the market leader. And I mean, this is only a hypothesis. We still have to study the household panel data, which will show where the movements are happening. But there's a possible move in that direction. But then that's a very sharply discounted segment, offers very little margin upsides. So not something which hugely excites us. We are looking at perhaps more offerings, but at the value-added segment, not which offers sensible margins, not really this 10 rupee price point strategy.
So my second question is on the beverages. Growth has been good, 27%. In the past quarters, you had mentioned that ITC and paperboard have become very aggressive on the pricing, promotions, etc. So if you could talk about that. And in terms of market share also, I think you had lost some market share. So any improvement in the market share?
Yeah, I think what happened in the third quarter was that there was a sudden outburst of very aggressive discounting by a couple of smaller players in this space. And it does take us around a few months to react because, there's a basic changeover time in terms of the laminate and putting in the promotions, et cetera, et cetera. So we were not able to do it in the fourth quarter, and therefore you saw fairly muted growth in the fourth quarter. But I think the revival has happened very strongly in the first when we have challenged those initiatives of the new players. And the underlying franchise is so strong that we are able to quickly get back to high levels of growth, which perhaps will be ahead of most of the competitors. That has reflected partially in terms of revival of market share. There is some revival. I think there's always a lag in terms of the Nielsen numbers, so I suspect that the numbers in this quarter will reflect fully the true extent of our market share gains or how much we have regained in terms of the earlier couple of percent points we lost.
So one follow-up on this business. You mentioned margins have expanded because of network optimization and RM. Could you talk about that?
Yeah, there's been some freight savings, but I think largely the input costs have been lower. And despite the fact that the rupee has weakened, so the imported pulp is a little bit more expensive, but aggregate, we've been a little bit lucky that the input costs have been fairly benign in the beverage space. And the network optimization of freight is a big component of input costs.
We have moved manufacturing to local where we have the incentives also, and the freight is
That's right.
And reduced dependency on Nepal and Sri Lanka.
Yeah, now the blend is around 40% domestic manufacturing, 60 Nepal. It was earlier on a little bit more in Nepal, and the network costs out of Nepal are obviously more. And Pantnagar also offers us excise benefits, etc., which make it very economical to produce there. So I think Pantnagar is the main cause. Also, consequent to GST, there has been some rationalization of freight, which the process of that has only begun. But we've seen some upsides in freight despite the very high prices of diesel.
Sir, last question in terms of honey and Chyawanprash, pre-Patanjali entry and current, what is the category size and where is your market share in terms of this?
Almost impossible to give you an answer to that because there is just no data available. We can only triangulate, use household panel data, etc., etc. So I prefer to let the dust settle a bit before giving you a clear answer. Definitely, the growth which you've seen over the last 3 quarters now in honey would indicate sharp increase in market share. Precisely how much? Perhaps we can give you an answer when the household panel data comes up, which will be when? Next month?
But it should be around, I think, 5-6%.
Yeah, 5-6%
from the competitor.
But when the household panel data comes, I think we can give a slightly more sharper picture of how much share we have and how much we lost, how much we have regained. But I think we are back to the highest ever levels in both revenue as well and definitely in terms of tonnage because there has been some price reduction. Fortunately, the honey input costs have been benign, so the price reductions which we've done over the last 1.5 years have not really hurt us. And there's been some impact in terms of the lower GST rates also. So overall, I think honey is on a very strong wicket. It's a very powerful brand with a lot of momentum.
Okay, sir. That's all from my side. Thank you.
Thank you.
Thank you. Next question is from the line of Sameer Gupta from IIFL. Please go ahead.
Hi, sir. This is Percy here. Sir, just looking at your numbers, like they are really good, and congrats on the results. 21% volume growth, but it also comes with a low base. So the way I'm looking across all companies, I'm looking at 2-year CAGR numbers to adjust for the base. And that is at around 7.5% to 8% 2-year CAGR, which is also very, very healthy in the given environment. I'm just wondering how to look at this going forward. For the remaining 9 months, your average volume growth in the base is around +9 versus a -4.5 this quarter. And if I am to maintain the same 2-year CAGR, that will yield me a sort of volume growth for about 7.5 to 8% for the remaining 9 months on a YOY basis. So is this the right way to look at it, or, is there some other way that is more appropriate?
Well, personally, I'll be very disappointed to show only a 7% growth going forward, because keep in mind the last 2-year CAGR is on the back of massive disruptions, whether it was demonetization, GST, and in our case in particular, disruptive competition. Largely in HPC from the player, and also a little bit in beverages. So now if we are able to navigate that, and on top of it, we saw a period of very slow consumption trends over the last 2 years. So these are massive, massive headwinds. And despite that, if we grew 7%, I think we can look forward to better growth in the quarters ahead, because many of these headwinds now appear at least to have, if not completely disappeared, at least weakened. You are seeing some revival of category growth. The first quarter numbers are pretty poor actually at this point in time, but green shoots seem to be visible in terms of what we are looking at in terms of June exit. Now 1 month of course is not something which we can extrapolate, but I think there's every reason to believe that category growths are going to go up, going to accelerate on the basis of now what it appears to be a normal monsoon. And the stimulus which the government will pump in perhaps more than anything else, MSP is just the first manifestation of that. I think it will further accelerate. So I see demand, particularly in rural, trending up perhaps sharper than what we would normally expect. So on that hypothesis, a 7% growth obviously is not going to be good enough. We should look at something much more, because in addition to what's happening in the category growth, our business has a lot of momentum, and we have a comparatively soft base even going forward. So let's see how it goes, but I think that this year we should be able to do double-digit volume growths in fiscal 19.
That is for the remaining 3 quarters or for the full year put together?
For the full year. I'm talking about the full year. It's very hard to predict remaining quarters, etc. But if you take the full year, double-digit volume growths seem to be something which we would definitely have to aspire to.
Right. But I mean, for the full year, you will reach a double-digit volume growth even if you do a 7 to 8% for the next 9 months, because the first quarter is so high.
You are very clever. So, but having said that, we don't give outlooks. We don't give guidance.
Fair enough.
So, but we are looking at good growth in the quarters ahead on the back of this extremely good growth in the first quarter.
Fair enough, sir. Secondly, on international business, we've had this quarter a very soft base, but in spite of that, the growth hasn't been that great. So could you just disaggregate that and tell us what are the different drivers of different geographies and how you expect these to pan out in the next 3 quarters?
Well, MENA is going to remain a little volatile, and but it will be much less. I think it will be much better off than last couple of years. But the volatility is almost embedded in that business as of now. So is sub-Saharan Africa. But there are some green shoots appearing in Namaste. I think Namaste will be able to deliver reasonably strong growth in the top line and very high growth in terms of margins. The North African business, particularly Egypt, seems to be doing well. We had a bad run in Algeria for the last 1 year, which now may be behind us. So Algeria will pick up. But then there are always negatives, and the big negative is Turkey. where despite extraordinary growth as far as the local market is concerned, 30% plus, we still get only perhaps 10-11% growth in INR terms. The currency devaluation remains unabated. Iran is another pain point, even though the market is small, but we did have high expectations of Iran, but the recent sanctions have perhaps made our plans now look a little aggressive. The currency, when we budget the currency at around 60,000 parts to the dollar, is now 100,000, and these are big changes which make the business model very fragile. So it's a mixed bag, but overall I think international business this year will deliver much better performance than in the previous 2 or 3 years. There's no doubt about it. How much more? It's like I said, it's very hard to predict.
Right, sir. And last question on margins. Your margins in FY18, EBITDA margin at around 21%, has been the highest in the past several years. So now in FY19, are you targeting margin expansion, or you would be happy to maintain these levels?
I'll be happy to maintain these levels on the back of very good volume growth. Again, the strategy of this company is today and always has been is to really focus on the volume growth without diluting the mix, so that a strong gross margin profile emerges and a strong net margin profile emerges, and then use some operating leverage to push up margins to the whatever extent it can. But sometimes when we move our APRO line well ahead of our top line, as we did last quarter, there can be some impact on margins, but it's of a temporary nature. This is a top-line driven business. We have 50% gross margins, and unless we do something silly, just by growing the top line will mean that the margin expansion will happen. So we keep a very sharp focus on revenues and not really have a margin obsession that I will deliver X% EBITDA or Y% EPS. That is the outcome really of the top-line performance.
Right, sir. Thanks and all the best.
Okay.
Thank you. Next question is from the line of Latika Chopra from JP Morgan. Please go ahead.
Yeah, hello everyone. Congratulations on a good performance.
Thank you.
My first question was, over the last 1 to 2 years, we have seen you competing very effectively and aggressively in categories like honey and juices to protect your market shares. And then we saw, various rural go-to-market initiatives coming through. In your view, over the next 2 to 3 years, could you call out any other major initiatives which are underway, which could accelerate the top-line growth momentum for you?
Yeah, I think one strategy which we are adopting, which I have articulated before, is to scale up brands within our portfolio, which have been not invested in for a variety of reasons. But we believe that many of them are poised to have a breakthrough kind of growth on the back of large investments. I'd rather do this rather than to build new categories or brands which come at enormous cost and very high risk of failure. So this is really what you'll see in this year and perhaps the next before we start looking at other categories to enter. Because there's enough headroom for growth adopting this strategy at lower cost and lower risk.
All right. And secondly, on hair oil category specifically, you had taken some initiatives on introducing low price packs. Are you going to adopt a more aggressive market share gain strategy there? And also, if you could share, for last fiscal, what was the contribution of Amla and non-Amla in the overall hair oil portfolio?
All right. So, Latika, Mohit aside, we guys are committed to be investing behind our mother brand, which is Dabur Amla. So, in the past, what we've done is we've introduced new initiatives in the economy segment, which is Sarson and Brahmi. They continue to do well, but these are not really margin accretive initiatives to Dabur Amla. But Dabur Amla, we will now very aggressively invest behind, and both at the trade level and also the media level, and gain back the market shares that we've lost to some economy players, while Brahmi and Sarson will continue to drive the growth at the rural end for us. So that will be the strategy for the hair oils. And overall, we look at gaining our market shares both in terms of value and volume in the perfumed hair oil market segment. We've also got players at the discount level in the coconut oil where we continue to gain value market shares there.
All right. And then just lastly on the margin question, should we expect pricing to move up in any material manner for you going forward?
Well, it's possible. I think there is now inflation pressures now emerging starting from this quarter and perhaps even accelerating going forward because unless oil prices come down very sharply, the agrarian material prices will trend up because of the MSPs and other such measures. So we'll have to mitigate that inflationary pressure. So I think price increases, which will not be dramatic, but perhaps to the extent of 3 to 4%, may be necessitated during the balance of year to like I said, mitigate these initiatives, which will also put a little bit of brakes on margin expansion because price increase will be used as a tool to manage inflation. But I think there would be no compression or margin consequence to inflation.
All right. Thank you and all the best.
Thank you.
Thank you. Next question is on the line of Prakash Kapadia from Anived PMS. Please go ahead.
Yeah, thanks for taking my question. Congrats on a very good set of numbers.
So before you proceed, sorry to interrupt, Mr. Kapadia, may we request you to please take the phone off speaker because...
Sure. Now is it legible?
Yes, please.
Yeah. Thanks for the opportunity. Congrats on a very good set of numbers. So if you could give us, some factors, in terms of pecking order for this 21% growth, in terms of, channel rationalization, is it government schemes, is it low base or GST reduction? What has, obviously, it will be a combination of most of these factors. What would be the most critical factor for driving this, 21% growth in the domestic business?
I think two factors stand out. One is our investments in media, 42%. They have yielded great results. We've also rationalized our go-to-market strategy in terms of the media platforms, and that obviously seems to be working. And then over the last 1.5 years, which I kept speaking about, the massive build-up of rural infrastructure, the separation of the health and personal care verticals down the middle, which happened around a year and a half ago, all that is now paying dividends. So as and when the green shoots emerge, and they do seem to be emerging as we speak, that infrastructure will come into play and drive the business growth. And even the media money is very well spent because in an environment of slightly bullish offtake, that's when media works best. So that's the reason why we have been able to improve shares and perhaps go ahead of our competitors, particularly in rural India. But I think other initiatives like our supply chain management also have played a part. Our fill rates are now improving, especially in modern retail. Our e-com initiatives are gaining a lot of traction. Now, these may be much less in terms of overall impact, but they are important inputs into the overall growth story.
Understood. That is helpful. And on the rural side, you mentioned about the momentum and the outlook being strong because of various, government push and factors. So, any specific geographies you would like to highlight in terms of rural? Is it more towards, northern part? Is it western? Is it across? Some sense on specific geographies?
Well, I'm not too sure about geographies. I think, as we head into the elections, the government will seek to have a favorable impression of the voters everywhere. But perhaps a little bit more concentration in the north, which are the big tilt states, including Bihar, for example, and a little bit less in perhaps the southern states. I'm not too sure. This is more of a political question. But if the MSP goes up, it benefits everybody. You can't, draw a line and say that it will benefit only so and so. So I think it'll be basically secular. And any stimulus would have a higher element of rural impact than urban. I'm not saying the urban impact will not be there, but that's more in terms of urban impact is more in terms of the macros, whereas rural is perhaps more in terms of the stimulus and other such micros. So that's where the difference lies. But to show a robust sale, we cannot just rely upon rural. This quarter was an aberration that rural grew around the same as urban. Typically, it grows higher, but that could be a consequence of the mix because the beverages, which is almost entirely urban, grew at a strong pace. So that might have tilted in favor of urban. Also, modern trade grew very well. E-com, we categorize under urban, grew very well, etc., etc. But again, rural has to take the lead. At least there should be, if you take the indicators, rural is growing as far as FMCG is concerned around 3.5% ahead of urban. That's for the FMCG category as a whole. And I think that kind of gap will perhaps remain. So rural is very, very important. Fortunately, we have a great armory of rural-centric products which we've developed over the last couple of years. And together with the distribution infrastructure build-up makes us a very strong player in rural India.
And some of the products on the rural side, so, it will be broader-based kind of growth going forward also across, say, HPC, foods, or will be certain categories which we are focusing on given, the strong momentum we are seeing on the rural side?
Yeah, HPC definitely, and foods with a bit of a lag. We're not really focusing at low-price products in foods to that extent, which are more oriented towards rural, which offer very little margin upside. So I think that beverages will remain an urban phenomena. HPC does draw a reasonable amount of revenues from rural, particularly in the traditional brands like Chyawanprash and Hajmola. These have a very strong rural franchise. But many of our newer products like, say, Vanitas, etc., or even massage oil, the rural franchise can go up manifold. But again, we have to invest in building the media profile of these brands.
Understood. That is very helpful. Thank you and all the best.
Yeah, you're welcome.
Thank you. Next question is on the line of Naveen Trivedi from HDFC Securities. Please go ahead.
Yeah, hi, good morning to everyone, and congratulations for the strong numbers. Sir, your volume growth is certainly higher than market and the competition. So if you can share what percentage of portfolio gain market share this quarter, and if you can also share the brand-specific market share change, at least for the key brands.
Yeah, I think Gagan will walk you through some of the numbers. But keep in mind, while Gagan will answer this, that Nielsen numbers operate with a lag. Now, the lag could be 2 months, 3 months, but there certainly is. So I do see the numbers which will come through perhaps later this quarter to be better than what they are today, even though today's numbers look better than what they were a year ago. But the market share gains are not, I think, fully reflected in Nielsen. So that does come with a bit of a lag. Yeah, Gagan?
Yeah. So basically, we are seeing on a mass basis the gains continuing in the toothpaste category. So our value share is now around 12.7% and volume share is around 15.5%. And value share is showing a gain of around 50 to 60 basis points. Other than that, hair oils is stable. I guess, but in volume, there is a gain of about 60 basis points in the hair oil category on volume basis. Value basis, it is stable. Shampoo is showing stable shares. The gain is not yet reflected. There is a lag in the shampoo category, and the fact that we are around 5% in the shampoo category, not yet reflecting the gains which we have been seeing, the strong growth which we have been seeing in the last 3 quarters. So these are the 3 major categories. We are seeing a gain in Chyawanprash category of about 200 basis points on that basis. And honey, as Mr. Dugal earlier said, is not available in AC Nielsen, but we will be waiting for the household panel.
Yeah, thanks for the update. I just want to understand one thing, like if my understanding is right, then the consumer-led promotions are net off from the top line. So do you think that any impact or benefit from the lower consumer-led promotion also has benefited on volume growth?
On volume growth, there won't be any impact on account of promotion because on the volume growth, there won't be much impact there because I think revenue that we reduce is more on the value side that you see when we publish the results. So on volume, there will not be, though there are some promotional issues that we have given, but that impact is very negligible.
In fact, we have reduced the promotions from last level. So in fact, it shouldn't have any additional impact on volume growth.
So we can say this around 21% growth is the underlying growth, has no change from that number.
Yes.
Okay. In your earlier comments, you were talking that the ASP spend and the marketing spend would certainly increase going ahead. Any budget if you can share for the next in FY19, and also if you can share the Capex plan for the next 2 years? That's all from my side. Thanks.
Second question first. The Capex this year is likely to be 250 crores, which is considerably lower than what we've done in the last couple of years. Next year Capex is, we haven't really, really put in the numbers for fiscal 20 at the moment, but it could be a little bit higher on account of a new plant in Egypt, but we haven't really quantified the impact of that. So this year you can take 250, might top up at 300, but 250 is probably a reasonably accurate number. And in terms of ad flows, yes, we will continue to invest much more in media, and we'll try to trim consumer and trade promotions to the extent possible. But the media spends will be aggressively growing. Now, we grew media by 48% first quarter, which obviously is not a sustainable growth. It will taper down, but I think it should be still in the perhaps the 20s, maybe even the high 20s in terms of YOY growth of media. Now, the outlook is a little bit more blurred on consumer and trade promotions, which of course the visibility you don't have, but they are integral to our A&P spends. And we'll try to taper them off as much as we can, but that is more in terms of mitigating competitor activity rather than a strategic tool. So they are more tactical, and it's very hard to predict how much we need.
Yeah, that's all from my side. Thank you so much.
You're welcome.
Thank you. Next question is from the line of Supriti Advant from Bearing India. Please go ahead.
Hello.
Hi.
Thank you for the opportunity. Sir, has the wholesale channel normalized, and how much would it be contributing to revenues now?
Well, I'll answer your question in two parts. The rural wholesale is actually doing very well. We grew how much this quarter in rural wholesale?
About 24%.
24%, so that's above the asking rate. Urban wholesale grew at only 8, and 7.7 to be precise. So the attrition of urban wholesale continues, which started off with demonetization, accelerated with GST, and perhaps the final nail in the coffin is now the e-way bill, because the urban wholesale is to ship across state lines, etc., which now becomes harder to do. So urban wholesale, the future doesn't look too bright. But one of the key reasons for building rural infrastructure was that we envisioned this situation to happen, and we took proactive action to mitigate it. So I'm not particularly bothered if urban wholesale continues to further decline. In fact, it might even be to our advantage, so long as we build the adequate amount of rural infrastructure.
Okay, thank you. And just another question. What would be the next steps for Namaste in USA?
Well, I think we put a new team in place, and I think the team seems to be now very energized and very focused in terms of rebuilding the chemical franchise and the adjuvant chemicals, which are more in terms of texturizing, etc., and not hardcore straightening. So, I mean, these are subtle changes in our business model. And the third leg of this growth will be to resurrect the whole naturals portfolio. It's small, but it does show signs of having significant upsides. So a combination of these three for North America would take the top line definitely ahead of what we've seen in the past couple of years. But the impact on the bottom line would be even more, because I think we've now pruned the organization to deal with the reality of the situation today. First quarter profit growth was enormous. I mean, it was actually a loss last year and a considerable amount of profit this year. And that trend will continue. So I think the challenge in North America would be how strongly can we rebuild the top line. Can we grow at 5 to 10% this year? I think it's eminently possible, but not to be taken as a given. The upsides will really come from sub-Saharan Africa, which is actually showing a pretty good scale upsides and growth. We grew by around 20-25% this quarter. And I think we can accelerate this growth because that market offers enormous opportunities. So I think on balance, the Namaste issues seem to now be behind us, and it will be a significant contributor to international growth.
Okay, that's all from my side. Thank you, sir.
Thank you.
Thank you. Next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, thanks for the opportunity and congratulations on good set of numbers.
Thank you.
So just picking up from your commentary today, there seems to be a strong premiumization trend in toothpaste category. So just wanted to know if you have...
I would question that. Why have the herbal players slashed the prices if there's such a big wave of premiumization? And why have, the hugely value-added products like the sensitive range and all not done well? So, this mantra of premiumization, I would question. I think premiumization is happening, but on a far more modest scale than what people think.
Okay. No, but you mentioned that value segment has done better than discount segment. So that's why I just wanted to know.
That's true, yeah, but I won't call it premiumization. What you're saying is right. I'm not disputing that the discount segment is offering much less value because even the premium brands are available at the discounted prices. So you have a 10 rupee Colgate, 10 rupee red toothpaste, a 10 rupee close-up, etc., etc. Now they may be lower in terms of grammage, but in terms of value perception, they are great. So that's one of the problems afflicting the discount segment. But I would call it premiumization. Premiumization happens when people move up the whole value chain into, the very high-priced products, which offer very specific niche benefits, and that doesn't seem to be happening.
Okay, so what would you call out this trend? Is the competitive intensity...
The trend is massification of the mid-range products. I think that is really the big driver of growth, that everybody now seems to realize that there is a pot of gold at the bottom of the pyramid. The margin realizations may not be enormous, but they are adequate to manage the portfolio, and the LUPs are driving a lot of that growth. Now, what we believe is that when affluence comes in and the disposable incomes rise, and we've seen that in category after category, people move up from the cheaper 10 rupee SKUs into the bigger SKUs. And that's something which, now again, I won't call it premiumization because they'll stick to the same brand, but it will mean better value, better realization in terms of margins for the key players here. So that is what perhaps the medium-term trend will be. The immediate trend is really massification of the mid-price products.
Okay. And sir, in last 1 year, because of GST and before that, because of DeMon, a lot of churn in wholesale channel has happened. So what proportion of original channel strength would be back in the business, and what will be lost for good? Won't be coming back in the stream. So just wanted to get a sense.
Yeah, I mentioned that in the earlier question that urban wholesale is perhaps, I would say it's going to be eliminated. It's still around 20% of business, 22% of business, which is a lot. But this slice would continue to come down if one were to just extrapolate current trends. Urban wholesale, rural wholesale will grow, modern trade will grow, e-com will grow actually at the highest pace and a pace which might surprise us. So these are the big variables here. And ultimately, e-com might even take a slice out of modern trade.
But sir, that's slightly counterintuitive because we always thought that urban wholesale is actually ready for GST and hence they will be better, the adaptability will be faster relative to rural wholesale. So, in fact, you started calling out this trend 2 years back that urban wholesale is losing market share to to modern trade because of value migration happening there. So, this trend might not have anything to do with GST, or am I missing something?
No, basically what was urban wholesale? It was a feeder into rural, like our super stockist network, which we call the rural wholesale network. So both of these were feeding into rural. And now one is feeding much less because of the compliance issues. Whereas the compliance issues in rural wholesale are much less because the scrutiny is much less. If you go to any wholesale mandi in any of the bigger cities, you will find immense level of scrutiny in terms of the transactions and a much less ability to, let's say, not comply with the rules, which makes this channel much less profitable than it was. So this is something which was pretty evident if you understand the way urban wholesale works. The compliance issues are going to impact it far more than rural, where the scrutiny, like I said, is almost not there.
Fair enough, sir. That's it from my side, and sir. All the best.
Thank you.
Thank you. Next question is from the line of Amit Sachdev from HSBC. Please go ahead. Mr. Amit Sachdev, your line has been unmuted. Please proceed with your question.
Yeah, hi. Thank you for taking my question.
Mr. Sachdev, may we request you to speak a bit loud? Your voice is feeble.
Just one second. Is this better now?
Yes, much better. Please proceed.
Okay. Hi, thank you so much for taking my questions, and congratulations on very good set of volume growth. So my question, Sunil, is that when we look at this such a strong number, and if I were to dissect it, how Dabur has changed over the last 1.5 years post Patanjali thing has started, I think the biggest change has been your approach to sort of responding to price and tailoring your value proposition across products has sort of changed. And honey has started doing well, or even, Chyawanprash has started doing well. Much of it, would you attribute this to the kind of pricing action and the promotion action you have taken, and that's a large part of the puzzle, or distribution expansion has played a larger role in this sort of sustained performance, or even the standout performance now? Or is it something else that has started working, that brands were strong and now with new value you're seeing more price elasticity there? How do we dissect this, and how do we read into your competitive response, especially in the context of when Amla was not responded, you lost market share, but now it seems like you want to be aggressive there as well. So has that approach now being more price warrior yourself and trying to sort of gain maximize volume growth and not really lose anything to the competition purely on pricing? So how do you dissect this 21% in various distribution, your pricing action, natural trends which are now getting a tailwind? How should we read into it, structural versus cyclical response from your side?
I think there has been some attitude change in part of management in terms of how we respond to disruptive or aggressive competition compared to the past. In the past, perhaps we were a little bit more concerned about defending profit. Now we are completely committed to defending share, and I think that's where the big difference lies. And also our response time to disruptive competition has been now accelerated to the maximum possible extent. There still are some lags because packaging changes take time to get on the ground, like they did in honey and recently with beverages. But that's a quarter or two, so it doesn't damage the brand beyond a very limited extent. So I think second thing what we do is we don't dumb down our product to lower the prices. And even if it is a huge amount of pain, like there was in honey where we kept the whole the product entirely the same but offered better value in terms of lower price, that's something which was really worked in our favor. I think the pressure on us, for example, in honey to move from glass to PET, which would have saved us around 10% in margins, was enormous at that point in time. The smartest thing we did was not to change that, because ultimately the glass pack is really the gold standard in terms of packaging. People are willing to pay a premium for it, and they respect brands which do not weaken the whole value proposition. So that's another learning. So in Amla, again, we would have tinkered around with the whole composition, but we haven't. We've resisted every change to put more LLP, etc., etc. But in Amla, we have done flanking strategy. We flanked it with aggressive price warriors so as to protect the flagship. So different strategies for different situations. But definitely our response time and our aggression to this situation has been is much more than before.
That's great to hear, Sunil. Just one small thing again on, the tailwind that has got created, at least, what seems to be working for oral care and other categories, which naturals consumer preference has changed. But it seems like so far you just gathered those tailwinds from the existing portfolio, but not much aggression was shown in sort of exploring some large new categories, or at least where the market sizes have become some significance in some product categories. What would be your 3 big ideas for the next 6 to 12 months, purely exploiting these natural trends?
Well, last couple of years have been pretty tough. So the whole attitude of the company was to defend, and rightly so, because we were under attack from multiple fronts. Now with those headwinds significantly behind us, we are getting back into aggression mode in terms of new products, and like I said earlier, in the shorter run, rapid scale up of some of the existing products on the back of heavy investments in advertising, in particular, advertising and promotions. So you will see more aggression, and that's reflected in this massive increase in the media expenditure. So the situation now is more facilitative of getting into aggression mode rather than just being on defense.
Sure. But Sunil, what would be those sort of, if not specific products, but what would be those categories that excite you and in that space, and how we should think about Dabur sort of exploiting which categories and how large they are, what sort of opportunities do you see in those categories? Not asking for very specific product launches, but some color of how you're seeing where Dabur is strong at, where you'll monetize this opportunity better than competition or maybe others.
Well, obviously, we got a massive equity embedded in our brands in terms of herbal and natural products. So that will obviously be the point of scale up and in high investments. But after that, which categories we go to, I prefer not to answer the question now. But we do have strong plans in consumer healthcare space in general, and also other categories, including beverages, to do some very aggressive investment in select product categories.
Okay, good. Thank you so much, Sunil, and congratulations on great set of numbers.
Thank you. Next question is from the line of Vicky Punjabi from JM Financial. Please go ahead.
Hi, good morning. This is Richard here. Thank you for taking my question.
Hi, Richard.
Would it be possible for you to share how does this 21% volume growth split up between juice and balance part of the portfolio? I'm just trying to get a sense of how important is juices in the volume scheme of things.
Well, it's important, but it's not dominant. I think juice volumes are up 26%, which makes the non-juice part maybe in the 18%. But that ebbs and flows, so it's not that this is structural. Tomorrow juice can be lower in the teens, and the other one can be higher. So I would put a big emphasis on it, the impact of juices on volume. It is there. But also keep in mind that first quarter is a big quarter, it's a comparatively large quarter for juices. Second quarter, you will find juice saliency shrinking considerably. First quarter, it was something like 22% of domestic business. It will probably be 15% in the second, and then be a little bit higher than that in the third, and lower that, and also higher in the fourth. So these are saliency shifts which happens because there is a seasonality element in juices, and that does impact the volume growth up and down.
Okay, thanks for that. And Mr. Duggal, I remember you used to talk about juice having become a very, very large category, and and this is a segment that can no longer grow at the 20s like how it used to consistently quarter after quarter, 2 or more years back. Has anything changed on that? In terms of the pacing of growth that you expect from this?
I think the future of juices has probably never looked better today than It is looking better today than it has been in the last few years. And one of the big change agents is, this whole scrutiny on sugar. And any beverage with a high level of sugar content, which is largely in the fruit drink space, is going to come under a massive amount of pressure on the part of the regulators to either declare the sugar content and give it some kind of traffic signal visibility. And the higher order beverages, particularly 100% range, are much less vulnerable to that. We also have some vulnerability in parts of our portfolio, but there is this massive fruit drinks market, which is thousands of crores in size, which perhaps offers an opportunity to pick consumers from. And I think, therefore, the juice outlook is very good, especially the higher-end juices. So I would put a lot of bets on my active range, which has no added sugar, because people will move up the ladder into low sugar, high pulp content juices, and again, we are the leaders in that segment, whereas we are really not present in the cheaper drink segment, which has high sugar.
Sure. That's very useful. And lastly, can you help me get some perspective on how Namaste's margin would have moved, in the last few years? I wanted to get a sense of how, what the deceleration has been and what has been the acceleration, and what do you expect going forward?
Well, the acceleration has happened really now. Once there was some momentum in the third and fourth quarters, but last year in the first quarter we actually lost money in Namaste.
So the operating margin or the EBITDA margin has moved up to around 12% this quarter. So it's been a very good quarter.
13% is the EBITDA margin, which is not bad at all, considering that we lost money and we had probably a negative EBITDA in the base quarter.
How was this, this figure looking for the whole of FY17 and 18?
17, what was the EBITDA?
No, for
18-19.
last year?
No, he's talking about 17. So 17-18. 17-18 is what it is.
I think it was in low single digits.
Yeah, it was like
probably zero. Yeah, and now it's 12 in the beginning of the year. No reason why it can't accelerate further. But even where we are today is a sharp turnaround from what we were in the last couple of years.
Sure. And this you're talking about the U.S. and Sub-Saharan Africa together?
It's a Namaste legal entity, which includes the Sub-Saharan component.
Sure.
But the figures now are, they are higher in Sub-Saharan, but that is virtuous because the Sub-Saharan growth is higher than North America. So the EBITDA profile in terms of mix will change. Yeah, there's exchange, etc. But overall, the localization agenda which we've had for Namaste in terms of now manufacturing in 3 African centers, Cairo, Lagos, and Joburg, is very instrumental in now moving up the profitability. Something like 80% of FSA sales come from local manufacturing, and this will probably become 90 or 95. And this is really a single prime driver. But in addition to that, I think the North American team, like I said, we have a new team there, is making very impressive moves in terms of cost management. So even I don't have the North American EBITDA, but while it will be lower than overall legal entity, it will still be sharply ahead of what it was last year.
Sure. And what's the the split between North America and Sub-Saharan Africa now in terms of revenue?
Around 62, 38, or 65, 35 in that.
64, 35.
64, 35.
So 64 is North America.
North America and 35% from the non-US geography.
And how was this? How much was this 2 years back?
It was around 25, 70. Sorry, 37.
So it's not moved very sharply, but the trend lines indicate movement towards Sub-Saharan. Having said that, I would be equally happy to see the North American franchise grow. It's not that we are concertedly moving towards Sub-Saharan. The Africa franchise is, where the incubation of the brands happen and where the brand equities are established. So that's also very important to us.
All right, got it. Thank you so much, Mr. Dugal. Wish you all the best.
You're welcome. Thanks.
Thank you. Next question is from the line of Sanjay Bimbalkar from Canara Robeco. Please go ahead.
Yeah, thank you. Sir, do you wish to call
Mr. Bimbalkar, can you speak a bit loud, sir?
Hello?
Mr. Bimbalkar?
Hello. Is this audible?
Yes, much better. Please proceed, sir.
Yeah. Sir, do you wish to call out for any change in inventory level at wholesale levels or any possible pre-buying due to e-way bill which you may have noticed? And secondly, are you noticing any significant change in the retail level volume growth?
Yeah. So I think what happened is demonetization and GST, the STRs had drastically dropped, whether it's the retail level or the inventories at the stockist level. Post GST, what has happened is it's gone back to a new normal, and this new normal is significantly lower than what it used to exist, both at the retail level as also at the stockist level. So at the stockist level, we have continued to be at the corrected pipeline, which came as a blessing in disguise, which happened to us. Today, we should be sitting at around 16 to 17 days of inventory at the stockist level. And STRs at the retail level has gone back to a new normal as we speak, which is lower than what it used to be earlier during the pre-GST era.
And sir, any change?
Sorry, just to interrupt. Can we stop the queue at the 7th? Okay. Yeah, please go ahead.
Please continue.
Yeah, sir, and any sense on the volume growth at consumer level or retail level, if you have any sense?
The volume growth at the consumer level is very robust. As you know, the volume has grown by around 21%, and which is secular across all our categories. So that remains robust. Going forward in terms of outlook, like Mr. Dugal mentioned, we can't put a figure to it, but we're looking at low double-digit sort of a volume growth going forward in the future.
Sure. Thank you.
Yeah.
Thank you. Next question is from the line of Nilay Shah from Morgan Stanley. Please go ahead.
Thank you. So our first question is just, again, going back to the domestic business, you did highlight last quarter that you were looking at market share gains, and that was irrespective of what happened to category growth. You've delivered that in the first quarter itself. So, if I can just go back and just try and pick your brains as to what were you seeing at that point in time to have given you this confidence of being able to pivot the business model to achieve this?
We're pretty optimistic in terms of the initiatives which we have taken in terms of the distribution infrastructure in particular, along with the commitment of the team to put money in behind media. So that outcome definitely would have been favorable. I think it was a little bit better than what we expected because perhaps there were some category tailwinds which are not reflected in the Nielsen numbers, but do seem to be evident. So, and the team today is very energized, very charged. I think the morale is very good after, we've come out of a pretty long 2-year type of trough. And we've come out stronger as a consequence. So, all credit to the team, both sales and marketing, ably supported by supply chain and others to deliver this performance. And I think this performance is sustainable.
Has there been any change from the top management communication down to the lines, to the brand managers, etc., that you can kind of share with us?
All we did was that we said that don't worry, this is temporary, this is not something which is going to remain. We'll emerge out of this stronger. Especially disruptive competition perhaps will be a long-term opportunity for us and a great opportunity because it will enable a larger slice of the pie for herbal and natural products, of which we are the natural owners, and therefore all these disruptions ultimately will work for us. So we also, at the cost of when we really were not able to support major infrastructure build-up in rural, we did that a year ago on the faith that this would ultimately have a very positive outcome. So I think we kept the momentum going, didn't get disheartened, and I think today we have emerged very strong from that challenge.
Okay. Moving forward, you spoke about the fact that there are some brands, some categories within your portfolio which are very small at this point in time, but have the potential of becoming very large products within your portfolio. Mm-hmm. You've spoken about that in the past. You've had a few instances where you've moved ahead on this agenda, baby care, juices with milk content, etc. But you've pulled back in the past for obvious reasons in the past. But what is your view on some of those opportunities as you move forward? When you speak about new categories, are they more of the same, Udli, etc., or is it more of a complete new revamp that you're thinking about?
No, it's neither. It's really looking inward at our current portfolio and seeing how much scalability does it have. Suppose we have a cough, cold, fever brand which is around 50 crores, operates in a 2,000 crore category, has got some unique benefits attached to it. Can we invest strongly behind it, scale it up to 200 crores? I think those are the answers which we are seeking. And that is really the opportunity which we are going to build at least in the next year or so. So then after that we'll look at adjacencies, like these value-added products which you spoke about. I think as and when this whole sugar issue comes up, the value in terms of milk additives, etc., would emerge. But immediately I think there's so much value which is lying unlocked within our current portfolio, it would be pretty silly not to take that as on priority.
Okay. And last question is on your inventory management. Are you moving to a replenishment cycle like most of the other consumer companies have, or will that still take time to be completely automated?
We are still ambivalent about a pure replenishment model. The current supply chain initiatives, it's a huge one which we are putting into play, which will end in the first quarter of next year, is really on improving the service levels to the highest possible standards. If it happens with a replenishment model or without, that's not something which we are overly concerned about. And I think there's some danger in a replenishment model which demands extremely low level of inventories at the distributor level. What happens when you have a transporter strike like we had, 1 week of complete disruption in terms of transporter? You have a one-day pipeline with the distributor. You have no recourse, you lose sales. Now, if you have a 17 or 15-day pipeline, which is, I think, the right one for us at this point in time, you really don't lose much in terms of sales. There'll be still some SKUs which will be out of stock, but majority will not be. So I think in a country like India with so many disruptions, floods, strikes, etc., trying to behave like you were in Germany sometimes doesn't work. So we have to adopt local solutions. At the same time, not compromise on efficiency, but not necessarily follow, things like replenishment model. Because the replenishment model, the way I understand it, necessitates very, very low inventory levels at all parts of the supply chain.
Okay, very clear. Thank you very much, sir.
Thanks.
Thank you. Next question is from the line of Amit Sinha from Macquarie. Please go ahead.
Yeah, thanks, sir, and congratulations on very good set of numbers. My first question is on your India business gross margin that has improved significantly. Now, one reason which you mentioned was the food business has done well because of the benign input cost. But what would be the other reason? Because you keep on highlighting pressure on the input side on the rest of the business. So is it a better product mix which is helping you to get this margin expansion on the gross margin side?
Well, the expansion has been modest. It's been around 1%, so it's not been game-changing. It's really been done because we bought ahead of the whole consumption cycle. We were basically consuming low-price raw materials which we had bought in the fourth quarter. And now this will probably peter out. It was fortunate that we did that because under the anti-profiteering, etc. Provisions, it was practically impossible to increase the prices even if there was an opportunity to do so. But now with inflationary pressures coming up, we would use pricing, at least a moderate dose of price increases to mitigate the inflationary pressures and keep the margin profile perhaps where it is today. It may not be possible, but at least we'll definitely give it a shot. In any case, I still think there is enough operating leverage in the P&L to facilitate good operating margin expansion. Of course, there would be some pressures in terms of non-operating income because we paid out a huge amount in terms of dividends, so there will be some shrinkage there. But if we just take the operating margin profile, I think it should remain, we should be able to. So that's really how things will work out. And then, of course, we'll replenish our cash reserves over the next year or so, a couple of years to where they were before we made this higher dividend. And then the non-operating income should catch up.
Sure, but you have talked about maintaining the gross margin levels compared to the last year levels. But there is a possibility of this expansion sustaining if you take adequate price hikes, right? I mean.
Yeah, but in an inflationary environment, it's very unlikely that gross margin will expand. I'm not saying it's not possible, but it's unlikely. So we're not looking at gross margin expansion, at least on a YOY basis over the next 3 quarters. Because inflation is almost a certainty which is going to happen. I think we are looking at around how much, 5% or thereabouts?
2.5%.
Sorry, 3.5%, but could go up. It could accelerate as and when the agrarian price hikes happen on the back of stimulus and MSP, etc., etc. And then, of course, oil is the big issue, which is so unpredictable.
Sure. Sir, secondly, I wanted your commentary on the shampoo business, which has been doing significantly well in the last 3 quarters. So what is working for us? Of course, you have made some initial commentary, but can you please give some more color there?
Well, the shampoo growth in the recent past has been driven by our rural infrastructure build-up. Now, going forward, we are trying to now premiumize the whole shampoo portfolio by introducing, let's say, relaunching it in a significant manner to cater to the urban audience, because ultimately we can't keep depending upon the rural part for growth. And I think we are pretty confident of our ability to resurrect this brand on the back of its herbal and Ayurvedic franchise for the urban audience, where it has been underperforming over the years. So that is a big challenge, and we are pretty sure that we'll be able to be on top of the thing, and the brand should show some resurrection, substantial resurrection, I would say, in urban India over the next couple of quarters, perhaps, maybe in the second half of the year. And the rural franchise should keep growing because I think it offers such great value and distribution. It's really a highest distributed brand. So it's got more distribution, more numeric distribution than brands which are 5 times its size in our portfolio.
Right. So is it possible to share, what percentage of hair care would be shampoo now, very broadly?
It's around
15% or 15%?
15% of total hair care.
So it's got a massive amount of upsides in terms of scalability because it's just a 5% market share. But with unique properties. It's now only the pure herbal brand left. There were a couple of other brands which have sort of fallen by the wayside. So we are pretty dominant in this space. If we play our cards well, we can build this brand into a very large franchise.
Yeah. Thanks a lot, sir. Thank you very much.
Thank you. Next question is from the line of Gaurav Jogani from ICICI Securities. Please go ahead.
Thank you for the opportunity, sir. Sir, as you have outlined that the rural growth is looking, the rural growth outlook is looking a bit better. However, sir, considering the monsoon in the Uttar Pradesh area, the Bihar, and mostly the central part of India, it hasn't been that great. So, any risk to that? I mean, the benign monsoon in those areas?
UP, the monsoon has been a little weak, but fortunately large parts of UP are irrigated and the water tables, the reservoir levels are still pretty good. So it doesn't seem to be a big issue as of now. In fact, the monsoon has turned out to be better than what we expected, let's say, a month ago. July rainfalls have been generally good, and even if they haven't been all that well distributed, the irrigation is taking up the slack. So we're seeing the good amount of growth in terms of the acreage planted, and with the MSP increase, there should be a jackpot for the farmers, because of high output and high selling price. It's actually a dream scenario. Of course, it will fuel inflation, but that's something which we'll have to deal with separately.
Okay. Thank you so much, sir.
Welcome.
Thank you. Next question is on the line of Harit Kapoor from IDFC Securities. Please go ahead.
Yeah, hi. Most of my questions are answered. Just one thing. You spoke about the, future outlook on price increases. Just wanted to know in this quarter, the increase in realizations or value minus volume, would that be more led by mix or lower promotions? Because I don't think there are any major price increases, right?
Not in the immediate term. So the volume value it will start now, the gap will start growing. Let's say Q1 was how much, 1%? 1%. Now, I don't expect it to shrink further. I think this gap will grow now because the price increases will kick in, and typically the value should be at least 2 to 3% higher than volume at least. Sometimes it's much more than that. Now, this will happen gradually because I don't see any major precipitous price increases happening. There's no reason to justify those kind of increases. So by the year end and exit, we may still have a 3-4% gap between volume and value. But again, it's not very sure about that.
Got it. That's it from me. Thanks.
Thanks.
Thank you. Next question is from the line of Sangeeta Purushottam from Cogito Advisors. Please go ahead.
Yeah, hi. Firstly, congratulations on a great set of numbers. My question actually related to the point you mentioned about your Capex estimates for this year. Could you give some kind of details on where this Capex is going to be spent? And I also wanted to understand your overall approach to Capex and basically capital allocation, because this is in general a fairly low Capex intensive industry, and if we compare Dabur to the other FMCG players, your ROEs are a little lower than that of many other players because the capital intensity is higher. So are you actually looking to change that in any way or look at more asset-light models in your expansion program?
Well, I think as far as our Capex this year is concerned, it is primarily with regard to expansion that we are doing in Tezpur. We are doing it in Pantnagar premises, so therefore there would be those capital expansion that we are going to spend this year as far as India is concerned, and international also. we are going to have in Nepal and a part in Egypt and other countries. So therefore, if we look at it overall, the Capex is going to be in the range of 250 to 300 crores this year. And if we look at it in the past, it was higher because we had made a greenfield capital expansion also in Tezpur and also in Pantnagar and other areas for the capital expansion. So whenever there is a requirement for capacity expansions, we are always going ahead with the capital expansion on that. Having said that, there is also a distinction between the categories where we need heavy capital expansion. For food category, the capital requirement is quite comparatively higher than other categories that we have in TCV. So it depends with regard to the category in which we are proposing for expansion.
Okay, so in food, for example, is it possible for you to outsource part of the production, which is what, in many of the other FMCG categories companies do, or are there any benefits to having it in-house?
No, there are benefits in both. We prefer in-house because it offers better margin profile and IRRs are very compelling rather than outsourcing it. So outsourcing is more a bridge in say, the summer, the season period to meet the deficiency in production rather than being a strategic element. But going forward, there could be categories in which the outsourcing model would work better than putting in our own capital. At this point in time, putting in own capital, which we did, let's say, to a considerable extent in Pantnagar for beverages, was the optimal thing to do.
Right.
But sometimes we may choose otherwise, and there are positives to outsourcing also.
Right. So do you actually have any kind of an ROE target that you look at when you, or an IRR target? Because, I was just trying to understand why your ROEs are so much lower than those of other players.
Well, our ROEs, if you net the cash off, are extremely high.
Yeah, it's actually quite high. Our IRR is excess of 19% that we normally take into account. The IRR part.
The Capex.
On the Capex. So therefore, that's the benchmark that we take before we take any decision.
What is our ROCE now? Is it net of cash?
Net of cash is close to 50.
Yeah, 50. Now, company may be 80, but you don't have to really follow what best practices are here. You have to see your own operating model, which sometimes demands, for example, our plant in Tezpur, which is a 500 crore plant. You can argue why put it up in that place, but the IRR of that plant are incredible.
Right. So that's what I was trying to get at, that, what are the advantages? Obviously, you would have evaluated both, and if you've chosen a particular path, just wanted to get an understanding of what advantages you see in that. And I missed an ROE number you gave excluding cash. Could you repeat that, please?
It's around 48.
48.
What you need to do is, you need to take out the cash reserves from the balance sheet and then look at the ROC or ROE.
Okay, and how much would are the cash, is the cash balance as of June end?
The net cash
is more than 4,500 crores.
That is gross cash, and there is some debt.
Net cash is more than.
Net cash is around 3,000 crores.
Okay.
We'll be paying out 1,300 crores, so you'll certainly see a big improvement in ROE. So.
Right. Okay, all right. If you could just explain a little bit to me that, what advantages that you got or you get of actually having the manufacturing in-house. Is there better control because it is the food sector, or just wanted to get an insight into that?
Well, I think apart from the cost synergies, there are also one element of fiscal incentive. So wherever we had the window open, we have taken the advantage of that by capitalizing in those areas to get the fiscal advantage. So that is also one of the important criteria of taking it. And second is also with regard to the synergies and the confidentiality that we maintain when we manufacture in-house. So therefore, that becomes important for us to do. And the third is also with regard to third-party margins. If we do it in-house, our margins are comparatively better than what we do it to outsource. So these are the factors which are relevant by deciding whether it is in-house or third-party. And third-party we do take wherever there is a short-term capacity shortage and we want to take the advantage of the demand. we certainly take the third parties also.
Right. Okay. So this 250 to 300 crores that you're planning to spend, how much would be in the food business and how much would be in the non-food business?
Food will be comparatively modest. I think 50 crores.
Yeah, 50 crores.
And, but, food is very cyclical. You put in a new Tetra line, which costs 50, 60 crores. And then 2 years later, you have to put another line. So last year, we put in a fair amount of Capex in juice. This year, not. But maybe next year again, we'll have to.
Okay. All right. Okay. Thank you.
Yeah.
Thank you. Thank you. As there are no further questions, I now hand the conference over to Ms. Ahluwalia for the closing comments. Over to you, ma'am.
Thank you. Thank you, everyone, for your participation in the conference call. A webcast of this call and transcript will be available on our website, and we'll be happy to address any further questions that you may have. Thank you, and have a nice day ahead.